We look at the same two examples for both the call and the put options. In the call option, the buyer had 60 days to exercise his option to buy the land for $1 million. He paid a premium of $25,000 for this option. From a financial standpoint, the value of the land must increase to $1,025,000 for the buyer to make a profit. The seller, on the other hand, is fine even if the value goes down or if the value remains the same. If the value remains the same, the likelihood of the buyer exercising the option is low, and besides, even if he does exercise the option, the seller would still pocket the extra $25,000. So now let's fast forward 30 days into this option's life. Let's assume the value of the land does not change. So after 30 days, the value of the land is still $1 million. What do you think the buyer and the seller are thinking at this point? The buyer is getting nervous because 30 days have passed and the value of the land has not increased. The seller, on the other hand, is quite comfortable. He knows that if in the next 30 days the value of the land does not increase, then he can keep the $25,000 as profit. Now, if there was an active options exchange around this kind of a real estate market, like we have in the stock market, then the buyer could try to sell his option. But now there are only 30 days to expiry. So if the buyer tries to sell this option, do you think he would get $25,000 for it? No, it's not possible. Any buyer of the option knows that there are only 30 days left for expiry of this option. So he'd obviously pay for only 30 days of time value. Maybe he'll pay about $15,000 for this option. So the original buyer has lost $10,000 of the option value due to time decay. So the takeaway is that all options are wasting assets. Because every option has a fixed time of expiry, then as that time of expiry approaches, the option will lose some value due to time decay on a daily basis. This time decay comes at the expense of the buyer of the option because he bears the burden of movement of the price of the underlying. Remember, he's paid premium for this option. So at the very least, his option or the price of the asset must move enough so that it can at least cover the premium. So that's where time decay really comes in, because the buyer starts off at a disadvantage because he pays premium over and above the fair value of the asset. And so this premium amount has to be recovered by the time the option expires. And this is really critical. So whenever you're an option buyer, you're paying a premium. And this premium may include any intrinsic value of the option, but it will certainly include extrinsic value because all options are going to have extrinsic value or time value built into the option price. So this extrinsic or time value will get eroded on a daily basis. And that's exactly what the buyer of the option has to overcome.